Hey, hi everyone. Welcome to this week's webinar. So before we get started, we're just going to give about 2 more minutes to let more people join the session before we get into it. Yep, I can see more people coming in. Hi everyone. Yep, in the meantime, let me know in the chat if you can hear me and see my slides clearly. And feel free to grab yourselves a drink, make yourselves comfortable, and I will see you guys in about 2 more minutes. Thanks, everyone. Okay, let's go ahead and get started. So for those who have just joined us, welcome to today's webinar. Today's session will be the third part of our Fibonacci series, and today's session will be on expansions. So let's go ahead and before we get started, as usual, a risk warning and disclaimer. So our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. So we'll briefly go through a recap on what we've talked about recently, the past 2 weeks on Fibonacci retracement essentials, so what exactly you can look out for, and what constitutes an ideal market structure. So what exactly are significant swings, and what exactly are the market trends that you should be following. And then we'll look at the different Fibonacci retracement levels, and then we'll get into this week's Fibonacci expansions technique, followed by how we can combine what we've learned previously with what we're going to learn today, and combine them to form confluence levels. Okay, so let's get started with our Fibonacci retracement checklist. So some essential steps. Firstly is the market structure clear. So we want to look for big zigzags or big price movements. Secondly is to identify the recent trend, so are prices going down or up. And thirdly, we want to look for recent major swing lows and recent major swing highs, followed by connecting the two extreme points, so the highest and lowest, or the lowest to the highest point, if it's an uptrend. Okay, so let's look at what exactly constitutes a significant swing. So firstly, here, let's look at an incorrect example. So here we have insignificant swings. So you can see in the example here, these swing highs and swing lows are too insignificant. So they're too insignificant to use as Fibonacci points. Okay, because the price movements are too small and there's no significant price movements. So here's another example. You can't really see any significant shape. Okay, and here we have a significant example. So you can see that there are obvious peaks and troughs in our example here, and we've drawn it out. And there's also clear market movement. So this is the kind of market structure that you want to look out for when you are deciding which charts to trade. Okay, again, another example over here. Okay, next, let's look at how you can follow the market structure. So in this example, you can see that the Fibonacci trend line, which is basically the line that we've drawn here, cuts through the price structure and doesn't follow the shape of the chart. So Fibonacci retracement levels should not cut through too large areas of the market structure. The Fibonacci trend line should follow the shape and should not deviate too much from price movement. Okay, so what you should do is, like in this example here, where we're following the clear downward movement of the trend, and the Fibonacci retracement trend line follows the price movement. And this tends to work better on higher time frames, so H1, H4, daily, weekly, depending on your trading strategy. Okay, again, here's an example of a clear market structure, and this is an example of an unclear market structure. Okay, and here are the different Fibonacci retracement levels. So the negatives are what we are going to be looking at today, which is the Fibonacci expansion. And then previous weeks in our first session, we went through Fibonacci retracement, which would be from 0 to 100. And then those that are above 100, so 127.2 and 161.8, those we talked about last week when we talked about Fibonacci extensions. Okay. And yep, so here's an example of it on a chart. So here you can see all the different Fibonacci numbers that we mentioned in the previous slide and how exactly it looks drawn out. So you want to firstly take note of the starting and the ending point of our Fibonacci trend line. So you can see the starting point is up here, ending point down here. Okay, and as we mentioned, mid-range are the retracements. Negative range is our expansions, so what we'll be talking about today. And those that are more than 100% are the extensions. So in all these three scenarios, we are only using one tool, which is the Fibonacci retracement. Okay, so let's zoom in and look at today's Fibonacci expansion technique. So before we get into that, I just want to introduce to you guys a website that you can use if you're just starting out on Fibonacci techniques. Okay, so you can go on to the forexarmy.com and it teaches you how to draw the Fibonacci retracement correctly. So it goes through, there's a video as well on each of the techniques, and then you can look at what you can look out for. Basically everything that I'm going through today, you can also find on this website. Okay, so yep, there's some examples here. Okay, and they go through each of the Fibonacci as well. So you can see here, they're talking about combining the Fibonacci levels, which is what we'll talk about later on when we're talking about Fibonacci confluence levels. Yeah, and here we're talking about how kind of trade management strategies. So you place your stop loss beyond, take profit before. So this is quite an important concept that we'll talk about at the end as well. So yeah, just wanted to briefly mention that if you're just starting out, and yeah, maybe I'll just pop it into the chat. Okay, let me go back to my slides. Okay, so let's zoom in to this week's topic, which is Fibonacci expansions, and we're just going to be focusing on the negatives today. So using the Fibonacci retracement tool, we are making use of the negative levels, namely minus 61.8 and minus 27.2. So when using this tool, ideally we look for this flash, zigzag, or lightning symbol. Okay, so price should retrace at least 50% in 0.3 as shown in the video here before reversing off. So you can see in the GIF I've included here. Okay, our flash symbol is drawn out in yellow, and you're taking the starting and ending point, or point 1 and point 2, and we are observing the negative levels. So of course, the first level we'll be observing is minus 27. So if price breaks out of the minus 27.2, then we would go on to look for the minus 61.8. But it's important to note that this 0.3 here should be more than 50%, which is over here where my mouse is at. Yeah, it should surpass that level before you can use this Fibonacci expansion technique. Okay, maybe I'll just pause here and let you guys watch the GIF a couple of times. Okay, so here you can see it's retraced even more, almost 76%. Okay, before bouncing off and heading towards our 27%, minus 27%, and retracing off of that level. Okay, so here's our first example. So here we can see how exactly it plays out. We have a starting and ending point here and here. Okay, and we can see the price retracing 61.8%. of the retracement that we've identified. And then we see how to make use of the support in the negatives. So here you can see we have a minus 27.2 that we're observing. So we're expecting price to retrace back here, and we're expecting it to bounce off of this support level, which you can see in this example it did do. Okay, so typically once price breaks out of the 0%, that is confirmation that it's gonna hit towards your minus 27.2. A pro tip is that price usually does come back to the ending point, so the same level over here, and it might test that level since it is now a overlap support or resistance level. So basically, what a overlap level means is that if there is a swing low as well as a swing high that lines up in the same level like we see over here at this red highlighted area. Okay, so how you basically use this technique is basically expecting price to react off of the negative levels or your support levels and then expecting it to hit back to your ending point. So pretty straightforward, but let's look at another example here. So take note of this zigzag shape. This is point 1, point 2, point 3 here, and then of course point 4 here. Okay, so if we are looking at it, of course, this example is with hindsight, but if we're looking at it before, we would look for this flash symbol, okay, before it reaches the minus 27.2, and then we place this Fibonacci retracement level and then project it to firstly minus 27.2, and then we can see it breaks out, and then we will go in for buy towards the minus 61.8. Okay, we can see it reverse off and hit back down to this overlap level here. You can see the swing high here and another swing high here. So it's a pretty significant level, even though we haven't highlighted it yet, because multiple swing highs have lined up in the same area. So we can expect price to react off of that area as well. Okay, another example here. Once again, take note of the flash shape. Okay, it has definitely surpassed more than 50%, almost 100% over here. And then price is reacted off the minus 27.2% Fibonacci expansion level. Okay. Okay, another GIF for you. So the yellow arrow is the lightning bolt shape, and we are placing the retracement from point 1 to point 2 and projecting it to hit towards or reverse off of the minus 27.2. Okay, let's move on. Okay, so a pretty important point over here. What makes an invalid Fibonacci retracement? So this is one of the most common scenarios where we see price making a lower low, assuming that you're drawing the Fibonacci retracement from the top to the bottom. Okay, so it's making a lower low, and there are bars on the right that break your ending point. It then becomes invalid. So there are Fibonacci retracements that are negative, like we've just went through in the previous slides. So those are valid. But if we are using a retracement, okay, I'll show you guys the example here. But if we're using a retracement from this starting point to this ending point, and we're looking for a mid-range, then this area, since it breaks out of the ending point, it is no longer considered a valid retracement. Okay, so price breaks our ending point on the right, and hence we cannot use this ending point as our retracement. So we want to always remember to pick the lowest point with nothing on the right of the ending point. So similarly, if you're looking at an uptrend instead of, in this example, we're looking at downtrend. So if the example is an uptrend, obviously you want to look for something that doesn't have a highest point to the right of the ending point. Basically this example, but flipped. Okay, now let's get into the fun part, which is looking for confluence levels. So what a confluence level means is basically when there are multiple Fibonacci retracement levels that line up together. So this increases the probability of a bunch of Fibonacci retracement levels working together versus a single Fibonacci retracement level. Okay, so okay, let me zoom into the example. So if you look at the red arrow, you can kind of see a pretty obvious lightning bolt shape over here, right? So the red arrow is our minus 27.2% Fibonacci expansion that we talked about today. And then our Fibonacci extension, which we talked about last week. Basically for that, you're looking for a Nike tick. In this scenario, we're looking at an upside down Nike tick or an inverted Nike tick where the head is the gray arrow and this black arrow is the tail. Okay, so for extensions, we're looking for levels that are above 100%, which we see over here. And that lines up with our Fibonacci projection. So for projections, we'll touch a bit more on that next week. But really briefly, for projections, we are also looking for flash or lightning bolt shapes. So typically, projections can be used with expansions quite a lot of the time. So for projections, we are looking at 61.8, 78.6, and 100% levels. So in this case, we see a 78.6% Fibonacci projection that lines up with all these other two levels. You can see since we have not one, but three Fibonacci levels lining in the same area, this makes it a very strong confluence area where we are expecting price to be attracted to it, but also bounce off of the area as well, because it creates a lot of resistance when multiple Fibonacci levels line up in the same area. Let's look at another example here. Okay, so in this example, price broke through the 127.2% level. Hence, we expect price to reverse off of the 161.8% Fibonacci extension and also the minus 61.8% Fibonacci expansion levels. Okay, so these line up and give us a very strong level. Okay. So like what I mentioned earlier, we would look for a retracement off of the minus 27.2 first before going in towards our minus 61.8. But once it surpasses, then we're going for a buy towards this level, especially since, we have these two levels lining up. Okay. Yeah, in our next example, here we have a minus 27.2% Fibonacci expansion, which is in blue over here. You can see the lightning bolt shape, I think. Okay, and then our Fibonacci extension, which again is the Nike tick, which is the purple arrow. Okay, in this case, it is also an inverted Nike tick. And then we also have a 100% Fibonacci projection, which is 3 points. So the starting point is here, middle point here, and ending point here. And those three levels all line up in the same area, which gives us this very nice confluence area where we can expect price to bounce off of this very strong support level. So one thing to keep in mind is that these tend to be areas instead of levels. So you can see even though our 127.2 is not exactly lined up with the minus 27.2, it still counts because we're looking for areas here. So as long as it's kind of near, it still counts as a confluence area. Because you can see here, when you have such a strong area, right, price is more likely to bounce off of it. So you want to make sure that you are able to catch that 1 or 2 pips before it reverses off. So that brings me to my next point, which is trade management. Briefly talked about this just now, when we were talking about the Forex Army website, because this chart is taken from there. But basically, this trade management technique helps you to make sure that you catch any reversals before it happens. Because those, like I mentioned over here, for example, you can see it doesn't really, it's just the wick of the candlestick that touches these levels. The actual body of the candlestick doesn't even touch it. So you want to make sure that you catch these levels before they reverse off of them. And this trade management technique helps you with that. So firstly, you want to make sure that your stop loss is placed beyond a key Fibonacci confluence area. Reason for this is because more often than not, price is attracted to such strong areas of confluence. And if your stop loss is right before, instead of beyond the level, chances are you'll most likely get stopped out before the market reverses. And that's one of the reasons why people wonder why they got stopped out right before the market starts to reverse, and they might start complaining about stop hunting. Okay. And for your take profit, rule of thumb is to place your take profit before your key Fibonacci confluence area. Again, the reason for this is because when price reaches the Fibonacci confluence area, there is a high chance that it won't be able to go beyond of it. So instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. So that's one of the reasons why people complain that the market might be manipulated, because they miss their take profit by 1 pip. Okay. Okay, that's it for our slides. So now we're gonna go into our live analysis session. So if you guys have any requests for any charts that you guys would like to see, feel free to pop them into the chat. Okay, I'm just gonna open my charts while you guys pop your requests into the chat. Okay, to get the ball rolling, I think I'll just start off with gold. Okay. Okay, sorry about that. Had some technical issues. Um, let's go ahead and get started with gold first. So let's look at our weekly time frame first, just to get an idea of where prices are headed towards. So we can see that gold is pretty bullish. Okay, let's see if we have a channel. Okay, not really. Okay, but we can see that prices are headed upwards. Okay, even though there are no trend lines or trend channels. Okay, let's look at our daily time frame now. And firstly, our first step is always to look for any trend lines or trend channels. Okay, just to see if we have a general direction. And you can see that price is moving within this ascending trend channel. So just to recap really quickly, what makes a valid trend channel is if there are two touches on top and two touches at the bottom of the trend channel. Okay. Okay. So let's go in and look at our support and resistance levels. So here will be my first support, and here would be my first resistance. Okay. Okay, so typically we will follow trend and we can see that price is bouncing off of the um trend channel. Okay, so following that trend, we are expecting it to hit towards our first resistance. Let's look at our 4-hour time frame now. Okay, on our 4-hour time frame, our first resistance would be a little bit closer to where price is at, which is over here. And you want to try and pull it back as far as you can, just just to see if you can spot any significant levels. So here, I'm pulling it back all the way here so that I can see that I have one swing high and two swing high here. Oh, okay. Okay. So that's our first resistance. And I think our second resistance will be here, since it is a double swing high. Okay. Let's go in with some Fibonacci levels. Okay, so starting off, um, let's go in with a projection. So this is my starting point, middle point, and ending point. Okay, and for projections, we use 61.8, 78.6, and 100%. Okay, so I'm just going to have all of those levels first. Next, I'm going to be taking a retracement because I want to see if I have any levels that line up with our projection, which you can see that is over here. Okay. Okay, so this is going to be a intermediate level. Okay. Because that's exactly where price is at currently. So we might be seeing some resistance here since we have two levels lining up, and this is also a overlap level. So overlap because there is a swing low as well as, so actually we have a couple of swing lows as well as a couple of swing highs. So it is a pretty significant level. Okay, and gonna be using another projection level. Okay, and that supports my first support level. And okay, let's see if we can find any expansions. Okay, so earlier we mentioned minus 27.2 and minus 61.8 are the levels for expansion. And you can see that, oh, so this is our lightning bolt shape in case you couldn't see it. Okay, and I can see that I have a minus 27.2 that lines up with, let's see. Okay, it doesn't line up with anything. Okay, but my minus 61.8 lines up nicely with my second resistance. So I'm still going to keep this level just in case price bounces off of that level. Okay, but for now, we are going to see price testing our intermediate resistance first, and we're expecting it to continue to move up towards our first resistance. Now let's pull out some indicators to support our analysis. So price is on our Ichimoku, looks like price is moving within the cloud. So if it moves within the cloud, it doesn't really tell us much. Although it does look like it's moving, it's exiting out of it if you look at the wick of the candlestick. But before that happens, we can't be too sure. So I'm going to remove that. Okay. And for our MACD, you can see it's giving us a bullish signal. So that's good. And if we look at RSI, okay, price is also moving in an uptrend. So that supports our analysis as well. And on our stochastic, it's also an uptrend. Okay, and let's maybe look at Bollinger Bands. Okay, it's not really telling us much. Moving average. Okay, price looks like it's moving above both of the averages. You can see the red wick is starting to move above our green EMA. Okay, so that also supports our analysis. Okay, so that's for gold. I think we have time for maybe one more chart. Okay, let's go ahead and look at the Aussie dollar. So on our weekly time frame, it looks kind of bearish, okay, with price moving in this descending trend line. So again, just to recap, what makes a valid trend line is if there are at least 3 touches on the line, which you can see we have over here. On our daily time frame, it also looks kind of bearish, even though we don't have any oh, actually it's currently breaking out of this descending trend line. Okay, so we have a really nice trend line over here. Okay, 1, 2, and 3 touches, and you can actually even 4 over here. You can see price recently broke out of the descending trend line. So there is a bit of a bullish signal over here. Now let's just go ahead and add some support and resistance levels again. Okay, so this is my first support. Second support. Okay, this will be my intermediate level because we can see there's 1, 2, 3, 4 swing lows that line up with that level. Okay, so this is my intermediate resistance. Okay, and over here is my first resistance. Okay, now let's look at our 4-hour time frame. Okay, now you can see on our 4-hour time frame, it looks significantly more like there's no real trend. Okay, it's ranging here. So that's why it's important to look at the higher time frames first and then zooming down to your lower time frames. Okay, here will be my first support. Actually, maybe here instead. Okay. Because it's closer to where price is currently at. Okay, and next will be my first resistance over here. Okay, going in once again with our retracement level. So I like to just look at all the Fibonacci levels first. Okay, and then see what matches up. Okay. So for projection, we use these 3 levels. And you can see they kind of line up nicely. Okay, I think my 50% kind of lines up with um my first resistance. Okay, so I'll just keep that. Okay, just a recap. Here we have, this is an example of a Nike tick. Oh, where is it? Okay, here. So you can see the head of the Nike tick here and the tail here. So in this case, we can see price testing the 127.2 level, but ultimately it did break out of it. But yeah, just wanted to show you how to identify the shape. Okay. Um, okay. I think that's all the levels that we have. Um, okay. I think that's all the levels that we have in this case. Oh, let's see if we have an extension here. Okay, so we can see the minus 27.2 lines up with the 127.2. But that's a bit far from where our price is currently at. So I'll remove that. And I will also remove this, okay, just so that it's not so messy. Okay. Okay. Now let's look at some indicators. So price is moving below the Ichimoku cloud, so it's giving us a bearish signal. Actually, it's moving within the cloud, so we can't even use that. And for our MACD, it is giving us a bullish signal, which supports our analysis. Okay. This is my first resistance. So we're expecting price to go from our first support. Maybe there will be some resistance over here at an intermediate level. Okay. Let's briefly see if there's any levels that line up. Okay, my 23.6 is quite close to where we are looking at. Okay, for our intermediate level. Okay, so we might see some resistance over here. Okay, let's look at our RSI and stochastic. Okay, they're both not telling us much. Now let's look at Bollinger and MA. Okay, Bollinger isn't telling us much. Price is moving above our SMA, so in the short term, it does look like price is going to move upwards, but it is moving below the EMA. Okay, but you can see that price crossed over here when price started to make a downtrend. But now that it's making an uptrend, we might be able to see this crossover. So basically, when the EMA and SMA cross over, it is a signal that the trend will change. So we might see that soon. And yeah. Yeah, so for this, we might see some resistance here. Okay. But ultimately, there is quite a bit of upward pressure that could push it past this resistance level here towards our first resistance. Okay. Um, do you guys have any questions? Any other requests? All good. Okay, great. If there are no other requests or any questions, then that's it for today's webinar. Thank you guys so much for joining me, and I hope you guys found it helpful. Have a great rest of your week, and I'll see you guys next week. Bye, everyone.